Why legendary investors wait. Lessons from Sir John Templeton for navigating market turmoil. When markets are in turmoil, most investors look to the crowd. But Sir John Templeton did the opposite. He avoided groupthink so much he moved to the Bahamas, far from the noise of Wall Street. His frugal lifestyle was a reminder. Sometimes the best stewards of your wealth aren't the flashiest. Templeton's contrarian approach meant he profited when others panicked. In 1939, as war broke out in Europe and panic swept the markets, the then 27-year-old Templeton instructed his broker to buy $100 of every stock trading under $1 on the New York Stock Exchange. That was 104 companies, 37 of them already bankrupt. His philosophy? The biggest opportunities appear at the point of maximum pessimism. He didn't chase chaos, but he wasn't afraid to exploit it. During the 1973-74 stock market crash, in the aftermath of the Yom Kippur War and the OPEC crisis, Templeton invested in US stocks at historic lows, always mindful of the fundamentals, never reckless. So, what would Templeton make of today's markets, with stocks at or near record highs, even after shocks in the Middle East? True contrarian opportunities are hard to spot. Tech giants, once the darlings, now have price-to-earnings ratios well below their 2021 peaks, but still lofty by historical standards. The so-called bubble might be gently deflating, not bursting. Templeton specifically avoided companies with elevated valuations. The tech cohort, with its tottering multiples, would likely be off the menu. But knowing his discipline, he would have recalibrated his expectations, watching the knowledge economy's growth over the last 15 to 20 years. Even so, anyone who insists a broad market sell-off will deliver easy entry points in tech is making a risky bet. A true contrarian would look for opportunities in capital-intensive, cash-generative sectors where fundamentals still matter. Ahead of the recent hostilities in Iran, we saw cash flowing into UK equities. Yet some of the smartest fund managers have been keeping reserves, waiting to take advantage of volatility. James Norrington at Investors Chronicle noted that their alpha portfolios had elevated cash levels before the crisis, using momentum signals to protect against shocks, but always balancing the need to stay invested. As for the war itself, history shows that whether markets tip into recession or a bear market depends largely on the duration of conflict. President Trump is predicting a 4 to 5 week campaign, but experience suggests market reactions to sudden left-field events are usually short-lived, except for the sectors directly impacted. That's why legendary contrarians like Templeton would likely keep their powder dry after a sell-off, waiting for the froth in risk asset valuations to dissipate before jumping in. In other words, patience is power. Don't rush in just because markets dip. Look for true value, not just temporary bargains. In uncertain times, following the crowd can be costly. If you want a strategy built on discipline, not hype, reach out to Elysium Wealth Advisors. Let's chart a course through the noise. Together, send us a DM or send email to info@elysiumwealthadvisors.com.